Hey, good morning, everyone. Welcome to the Friday Gimbal Financial webinar. Thanks to Zoom for creating this space where we can do this kind of thing. It's pretty cool. Got some disclaimers up there to make sure that we are all good with compliance. Look before driving. That's up there. Keith is wandering around on week 2 of the guy's RV trip, and so I can't wait to see what Keith comes back with. He's going to have some opinions, but this content, the stuff we talk about here, this is this is great conversation, but there's no guarantees of future results. I might get excited. We might get excited talking about the market or looking about the Fed data, or we might talk about ideas, but who knows? The market will do what it wants to do. It's one of the things that I love most about the stock market. The stock market doesn't care what your family makeup is. It doesn't care where you're located. Doesn't care about economic success or lack of success. It doesn't care about your educational background. Doesn't care what color you are. Doesn't care if you can see, if you can hear. It doesn't care about anything. And so it's an equal opportunity employer. So I love the stock market in that way. But anyway, we're going to look over some indices like the S&P 500 index, the small cap 600 index, and the NASDAQ. Those are just basically indexes. They're not the market. The market is a whole bunch of stocks. So anyway, let's get on with it. I'll stop this here. Okay. I thought we'd kick off the day. Well, and just shout out to Keith. He is wandering around, but the thing about Keith is and some of you know this, at being a business owner or highly involved in business, you know that business processes and thoughts, it never sleeps. And so one of the things that Keith does for us, and he does it really well, he does it consistently, is he writes this newsletter, The Anchor. And there you can see Keith right there. Keith writes this newsletter faithfully, and he's been doing it forever. We've got a lot of content stored in our files of, just great articles and topics. And some of these types of topics just they never get old. They stay the same. And so anyway, I hope that you're enjoying the newsletter. If you're not getting the newsletter, or if you would like to have it in a different format, let me know. Give me a call, 317-863-3815. That'll go to right to my desk. But yeah, thanks to Keith for writing this newsletter. It's good stuff. We are still, currently in a bear market. One of these days that's going to go away, but the typical bear market, like we talked about last week, lasts about 14 months. And we are on month 10. And so will this go 14 more months? I don't know. What was yesterday the day for the reversal? I have no idea. But we can get in line with what is and take a look at the stock market. And that's the type of stuff that we intend to talk about with you today. So let's take a quick look at the economy. Consumer spending is still coming in hot. And that's what happened yesterday. You saw the market is very volatile based on some economic news about how the consumer is spending their money. And we've talked about it time and time again on this show that the consumers is still spending a lot of money. If you were to go to your Chevrolet dealer and want to buy a new Suburban, or go over to your Honda dealer and want to buy a Civic, you're going to have to wait. You're going to have to wait if you want a new one, because the buyers have been buying up the supply, and there's not enough supply to meet the demand. Therefore, you got to wait. You got to wait a couple months. It'll roll in, but you'll have to wait. And the prices are fluctuating. Interesting. payrolls are up. And so that's a positive. Voluntary job leavers, the quitters out there. So for all you all who are quitting your job, you're at your highest level since 1990. And normally people don't quit jobs when they don't have another job lined up, or if they're not optimistic about their future. And so the number of people quitting their jobs amongst the unemployed, it's the highest ever. So pretty interesting stuff. GDP is still tracking 3% gross domestic product, and so that tells us that the overall economy of the U.S. is pretty strong. Export numbers look good. So what needs to happen here in order for inflation to come down, prices to start normalizing out? Probably a few things. I know if we've talked on the phone, there's been a couple ideas that I've thrown out, and those ideas are elections. If the Republicans were to win the House, that would throw off or that would create a balance of power. And so you'd see gridlock in Washington more than usual. And that gridlock, the Republicans would put together a proposal. President Biden would veto it. President Biden might have an idea, throw it over to the House. The House wouldn't even hold a vote on it. And they just fight each other. It'd be gridlock. And typically the stock market, stocks like to see that because they're too busy worrying about each other than to target business and the growth of business through maybe new regulation or taxes. And so when nothing gets done in Washington, business tends to do pretty well. So that's one thing. The consumer, slowing down their spending. And then the other thing that would really be great, and we're starting to see it, is if the money supply were to start to level out. And I want to show you a screen of that. This is the measure of money, the measure of money that's in the system today. And I went back to 1998, and you'd have to jump in the Doug Shreve way back time machine. Come along with me to 1998. I was a senior at Taylor University, and I was really building a lot of momentum, a lot of curiosity about what this space looks like for investors, what it looks like to be a financial consultant. And at that time, there was a professor there named Rick Seaman, who was a really great man. Rick passed away very young. He was an Edward Jones broker in Marion, Indiana, who decided to help kids pour themselves into the investment and financial space. And so he created a course to allow kids like me and others to pursue interest as financial planners. And so, way back in 1998, the stock market was rocking. And what this chart shows you is back then, there was $4 trillion in the money supply. And the money supply could be, everything from bank accounts, checking accounts, saving accounts, money markets, lending. And so it's a pretty broad definition of money that is available to use. But you can see we've always had this trajectory where it's going up. The supply of money is growing. And from 2000 to 2011, we went from, what was it, 4 trillion, 2011, where was it? There we go, 9 trillion. But then we really shot up right here. This is the COVID expansion. And why did the money supply shoot up right here? Why has it shot up? in 2020 all the way to 2021, 2022, we printed a lot of money. And so that money is now in the system and it's being used. I believe because this money was printed and created into our system, that's why we've seen inflated prices on housing. You know, how housing, it doesn't matter where you live. If you had a place in San Diego or you had a place in Yorktown, Indiana, uh, chances are your real estate went up, and it went up pretty dramatically compared to what you'd experienced over the last 20 years. Well, all this money that was put into the system was chasing fewer goods. And so here we are, you know, these last couple of months, the trajectory has leveled off, and that's a good thing. And we believe that if this can continue, this real small little spot here, if this can go sideways for a little bit, that would be a great thing. That would be a great thing for our future, slowing down the growth of the money supply. We believe could be the one thing that can help reduce inflation. And so anyway, that's a picture of where we've been. And if you want to talk more about that, you know, definitely give us a call. Love to do it. I had to, when I was looking at, you know, that chart on the Fred, when I was looking at that chart, I was trying to think, okay, what is $1 trillion? And so I just printed this out for you. Okay. So that's 12 zeros after the one. And for you math people, you know, check out what I did for you here. And so that's just an unbelievable number. 10 to the power of 12. 12 zeros. Anyway, let's get on to the markets. You guys know I have my gauges that I like to look at. I like to share these things with you. I like to share my gauges so that you can see how we form our world views on the market. And these gauges just help us see what's going on. I mean, because we all have our feeler. I'm reading this book, The Psychology of Money. That's probably a course that everybody should take in high school or college. But so we know how our feeler is. And, you know, if something breaks, if it's your garage door, your water heater, whatever it is at your house, it hits the wallet and it causes you to feel a certain way. You look at your finances and it's like, man, I'm taking a bigger hit this month. And so with the stock market, it's the same way. I like to have gauges. It just helps me put data to how I'm feeling. And sometimes, a lot of times, it just reduces the emotions if I can look at some data and see what's going on. So let's start off with the American Association of Individual Investors. I'm a part of this. I vote on this every week. And this over here is the sentiment view. And this is basically the question is, what direction do you feel the stock market will be in the next 6 months? So if I ask you that question, all right, here we are. It's October. Where do you think the market will be by spring? What would you think? Do you think it's going to be up? Do you think it's going to be down, or are you just kind of unsure? And it's interesting to me that you can see in the latest sentiment survey, only 20% of those surveyed are optimistic on the stock market. 56% are bearish, which is not the high for the bears. The high for the bears was right here on September 21st. And so you start to see folks who are a little more neutral. They're not sure. And next to this is the fear and greed index, the bull bear index. And when things are down, like when there's few bulls, this index would say it's a good time to get a little more greedy. And I don't have a problem with that. But you need to know, and I need to know, when is the right time to take a look at the market. And we believe that's the 200-day. That's something that we always talk about. So let's go into that. Here's our gauge on what stocks are doing with their own 200-day. And you can see that today, 19% of the S&P 500 is above their 200-day moving average. Yesterday was one of the more interesting days of the market that I've seen. You can see that it opened up and it went down. I mean, there was only at one time 12% of the S&P 500 was above its 200-day moving average. And then in one day, well, bam, 19%. And so yesterday was just a really wild day in the market. And we're going to get into that in a little bit. Another screen we like to look at is the Investors Business Daily. And share that with you real quick. And this is stuff you all can find. Some of the stuff I pay subscriptions for, Keith and I. But yeah, the market's still in a correction. There's been more sellers than buyers. And so it's just been a tough season to be an investor. So yesterday was really wild. I came in and Eric said, "Hey, did you see the stock market gap down?" And I know, I was enjoying my coffee. I was at the coffee shop going through my day, and then I come in and I see that, and it didn't take long for it to just completely rebound and go the other way. And that's super interesting because it's typical that bear markets, and we're in one, bear market being a 20% drop or decline from its high. The bear market that we're in, it's typical to see a lot of swings when you get closer to bottoms. And so yesterday was a pretty volatile swing. Let's take a look at that. Okay. So here we go. Got my volume thing in the way. All right, here's a picture of the S&P 500. And you can see right here, it went low quickly and just rebounded back up. And so that type of movement is pretty wild. And it did it on above average volume. Down here, if we see one of these vertical lines cross this red kind of zigzag horizontal line, the red zigzag horizontal line, that's the 50-day average, moving average of all the buys and sells that take place. And so of all the buys and sells that take place in the S&P 500, if the volume, the vertical line, crosses above the 50-day moving average, that tells us, there's just a lot of buying or there's a lot of selling that takes place that day. And so we're constantly watching that. But yeah, pretty wild day yesterday. And where I find this super interesting is you've got to go back to, let's see here. Yeah, September and October 2020 to hit those prices of the low yesterday. And so like this move right here that I have the cursor on, this was just after Labor Day 2020. We had a big, huge run right here. And then on Labor Day, it sold off and we had a decline where the stock market actually went under its last 50-day moving average. And then it shot back up. But this was a big sell-off. It happened in a blip, but it's a technical indicator. And so here we are, where the low of yesterday was in line with the peak of that September 2nd date. And that's very interesting. So if you have been an investor, let's say you put all your money in on September 2nd, you had some big time gains that carried you through right here. And then, we've given them all back. And so this is why it's important not to just be a buy and hold investor, but it's important to take a look at what you own and know why you own it, know when you would sell it. So that's the S&P 500. The NASDAQ looks very similar. The NASDAQ again is just, it's more stocks. It's 3,500 stocks, but as you can see, it did the same thing. Got to go way back here. Oh, that's even worse. Got to go way back to summertime 2020. So the NASDAQ sell-off has even been more intense. And I would expect to see this type of volatility as the market tries to discover its lows. So anyway, it's a great time to be an observer, to stay patient, and to just know that there's going to be better days ahead. I mean, this is America, and America rewards the innovator. It rewards the person who's willing to step out and make things more efficient. And we'll see that reflected in stock prices. And so it's a good time just to be patient right now. The 200-day moving average is still in a downtrend. The 50-day still in a downtrend. And we look forward to the time when we go above those. But for now, it's just a good time to stay patient. The psychology of selling, if you think about it, I'm just going to pull up the S&P 500 again. You've got all these people who in their 401ks were buying here this month, buying again with their paychecks, right? Every month, just coming in and buying and buying. And there's a lot of people who bought at the top. I think buy the dip. That was something I heard all the time. Buy the dip, which I don't recommend you do that. But that was a practice. And so all these people buying the dip, whenever the market would pull back just a little bit, buy some more. And so you have people who have their prices bought in, and you got people that bought all the way up here. And do you know what they're saying? These folks right here are saying, as soon as I get back to this level, I'm selling, I'm reducing my risk. I've learned my lesson. I'm going to be 60% in the market, 40% out of the market, whatever. There's a lot of people saying that. And so that until we get back here, there's going to be pressure for any movement in stock prices that go up, because they're going to be encountering sellers along the way. Once we get through that, the air's a little cleaner, and there's no sellers ahead of other people. And when there's no sellers putting pressure, stock prices tend to rise. So that's a pretty cool thing. A couple other things to look at here. Let's take a look at the VIX. It's been a while since we've talked about on this show. So the VIX, it's a measure of volatility, and we don't like to see these really long lines. These really long lines, I'll go to a daily here. These really long lines, vertical lines, tell us that there's a lot of disagreement amongst stock buyers and stock sellers. We prefer to see really tight lines, like maybe something like this. Let's see. Let's go back to 2017. Yeah. Okay. So we like to see tight lines right here. This tells us that there's not a whole lot of argument in price. And my goodness, the VIX here is down like, what is that? I did 10. Been a while. And so we're looking for tight lines because that's when folks are just, they're not as willing to give up as much, and the emotions and the feelers aren't quite as intense. So that's what's going on in the stock market today. And as we head into November, I expect to see more volatility. I expect to see it because the Fed is more than likely at this point in time to be able to slow down this economy. They're probably going to raise rates again, and we're, November could be another 0.75%. December could be definitely be. I would think it'd be another quarter. It could be a half. I don't know, but the economy's it's roaring. So I expect to see more volatility, and it's a good time to just stay patient. And so, if you have questions about your individual investments, definitely give us a call. And we're happy to talk with you about those. Um, did you see several of you who joined the call? Did you see that you're going to get a pay raise? That's always good. Um, did you ever have to ask for a pay raise? This time, looks like Social Security is saying, "Hey, we understand stuff's getting more expensive," and they're pointing towards a little bit above a 8.5% cost of living adjustment, COLA, cost of living adjustment. And so you're going to see a pay raise in Social Security, and that's good. But it's the highest pay raise in 40 years. And I highlighted a couple things because I know a lot of your money goes towards healthcare, goes towards food and gasoline, but with food, I thought, okay, here's a great time to do the Atkins diet. Now, I'm not a medical professional. I'm not endorsing. I'm just making a joke. But cereal and bakery products are up 16.4%. I pulled this information off the Center Square website. They're like one of those websites that has local news for each state. That type of stuff is trending. It's kind of cool. But the Center Square. And so they said cereal and bakery products are up 16.4%. Guess what the Shreve boys eat more than anything else? I mean, like Caroline can fix a fantastic meal, and afterwards they're eating a bowl of cereal. And so like, I think I could save some money if I just, quit buying cereal. So Atkins diet, there you go. Dairy products, they're up 16.2%. But here's the winner, fruits and veggies. If you want to save some money, skip the cereal, skip the dairy, fruits and veggies, only up 9.4. Can't beat that. So anyway, that's what's going on with where you are spending your money and the logic behind the Social Security increase, the cost of living adjustment. So highest in 40 years, pretty interesting. Lastly, the last thing I had for you today was just to encourage you to live. I met with one of you back in the spring, and I was over at your house, and I said, what's the future look like? And she said, I want to live. And to her, living meant being with her family. Her family lives out of state. It meant traveling a little bit. And so I want to encourage you to get out there and live in the way that excites you the most. And the thing right now that is really exciting me is just seeing our kids launch. And one of our boys is in the Carmel marching band. We had the opportunity to go watch Carmel's Wind Symphony 1, I think is what they call it. And I don't know where I'd have to go to find someone as good as these guys. I mean, they've won the state of Indiana solo wind ensemble competition 4 years in a row now. And I mean, would you have to go to New York, Chicago? I'd love to see them at the Palladium here in town. But I want to encourage you to find ways to live. And if you live near a college or if you live near a high school, they're putting on stuff, football games, concerts, plays, and it's a cheap way to enjoy the good life. And they're also teaching our kids really fantastic things. And some of you has seen this. Coach John Wooden, Indiana guy, he put out this pyramid of success table, and I love it. This pyramid of success table was handed out to the Carmel High School marching band on day one back in July this year. And so Warner came home and we walked through these, like, here's the baseline of success, having some friends, being loyal, having some enthusiasm, and then building it all the way up. If you get a chance, just Google John Wooden's Pyramid of Success table, go through it and ask yourself, hey, where am I on this thing? And where am I? Where do I want to be? And these two up top, I love so much. We've talked about patience. And to be a successful investor, you got to have a ton of patience. You also have to have some faith. You have to have some faith in the system. I know you guys have trusted us greatly, and we don't take that lightly. We know you can go anywhere. We love you, but we know you can go anywhere. And so we appreciate the trust. We appreciate the faith that you've shared with us. So anyway, my time's up. I've really enjoyed being with you again. And I'm going to be out next week. I'm going to be out at a conference. I'm part of a group of guys that 9 of us meet every Monday via Zoom, talk about business, family, talk about finances, life, wins and losses. And 2 times a year we get together. And so we're going to get together in Southern Indiana. And so I'll be missing you next week. But Keith will be back on, I think. No, Keith will be back on. And we'll just look forward to seeing you guys. And I know Keith will look forward to sharing his adventures with you. So live, Livin, I think Matthew McConaughey said. But you guys just have a great weekend. And I'll see you in 2 weeks. All right.